You talked about the transaction volumes dropping, and therefore that affects the amount the miners earn for every block they find. What is the range that we've been seeing in terms of percentage of the revenue that's coming from block reward versus transaction?
1% or so of the total reward comes from transaction fees. 1 to 2%.
Oh, so
very,
it's still
very low.
Very low.
Contrast that with the bull run in late 2017 and 2018. We were seeing 150%. And that was also when
Hold on, you're saying the bottom is 1%.
What's that?
You're saying the bottom is 1%.
The bottom right now is about 1%. During 2017, 2018, we were seeing transaction fees being 150% of total block reward.
Was that when you would pay $50 to just get into a block?
That would more than that, but yeah, during that time you were paying massive fees. Right now you can fit around 2,000 transactions per block, and there was just a massive backlog, and people would.
Is there a chart for that?
Yeah. It's on Hash Rate Index, so you can pull it up there. But yeah, so during that time, transaction fees as a percent of the block reward were insanely high. We also saw consistently that pre-mining ban, transaction fee volumes were much higher, double digits, teens, low teens. And post-mining ban, it's never been the same. And so that's led a lot of people with tinfoil hats and conspiracy theorists to think like were the Chinese pools doing something, or like Chinese miners trying to inflate the amount of transaction fee in the block.
For what reason?
To increase their total mining rewards. So they knew that they had the majority of the network. They would mine the majority of the blocks. You could probably do some math to figure out if I make sure that the amount of transaction fee is above a certain amount, I'm going to start my expected value from doing that activity is X. And
but isn't that cost neutral? Because if they're faking, they're actually having to spend the Bitcoin to put them in the transaction.
Well, they're spending the Bitcoin, but they're getting the Bitcoin back because they mine the blocks. And then the marginal transaction, so your and my transaction, or whoever's, they have to pay that higher fee, and then that gets captured.
So they're driving up our fees.
Yes.
Aha.
Yeah. Well, that was there you go. Yeah. That's
okay. So
that's average transaction fee,
and then as a percentage.
As a percentage.
And then here it is as a percentage. Yeah.
All right. Okay. So generally, it's about like.
So then you can see the mining ban there at the bottom right, and we've just never really recovered.
So the mining ban is that like mid-2021?
Mid-2021, yeah.
Okay, so 2019 to 20 got up to about 10%. Then there's a massive amount of activity, but that is also bull run time.
Yeah, bull runs cause transaction fees to go up, cause hash price to go up, margins to go up. Everybody's making money. Everybody's figuring out how can I lever up, how can I pour money in, how can I get ahead of this? And then they just expected that to go maybe another 3 to 6 months. I think if we had seen hash price above 15 to 20 cents for another 3 to 6 months, a lot of these miners would be in a much better position. They would have been able to get a little bit further through their very aggressive amortization schedules. They would have had a more balance sheet to withstand that negative free cash flow that we're seeing now. And they would actually I think they'd be in a really good position to, weather the bear market. Because, a mega miner like that, they do produce positive cash flows. It's just when you add in the leverage, that's when things start to kind of break down.
Right. Okay. And do we know if the Lightning Network has reduced the number of transactions within that go into block reward? So, for example, we were selling our merch at the Pacific Bitcoin, as you know, and I would say, I think we did maybe around 100 Lightning Bitcoin transactions, of which 5 would have been base chain.
Okay.
We still did them because people didn't have any Bitcoin in their Lightning wallet, and the rest were Lightning. Now, the Lightning ones, if the channel's already open, there's no transaction fee going to the miners, but the base chain ones there are.
Right.
Do we know if the Lightning Network is having that impact, or is Lightning Network just new transactions that wouldn't have happened?
So it's hard to say. I don't know exactly if that is the theory. If you're not conspiracy theorist about the Chinese miners producing transaction fees that introduce kind of a base layer of fee reward, that would be the other one of the other causes, or it's just lower interest in the network as a whole. If I would have gone over and bought stuff from somebody that had a way to pay with Bitcoin, probably would have done a base chain transaction because it would have been 5 cents.
Yeah.
Lightning right now is it's hard to really justify opening those channels just due to the economics being so in favor of using base chain currently.
What miners meant to be using futures to protect themselves against these situations?
Okay, well, thank you for the meatball. So,
yeah, well, so I don't fully understand futures, right? I mean,
Right.
I do. I know you can hedge. I know historically from watching, is it Trading Places, where they're the futures for the orange juice market, and the futures are there to protect if there's the crop isn't as as they expect.
Right.
If there's storms or they don't harvest as many oranges, the futures give the farmers a stable price to have a stable income for their land.
Right.
And my understanding was meant to be the same for Bitcoin miners, that the futures would exist for them to protect themselves for this kind of variability.
So there's really no future product that exists today for hedging your outputs. So there's output of a Bitcoin mine, which is Bitcoin and generally dollars. Bitcoin miners most generally should be trying to get to dollars to reduce the risk on their operation. And then on the inputs, that's just energy. And so there are some ways to hedge energy today. You could buy energy forwards. You can do different types of strategies. Maybe buy if you know that your energy source is nat gas, you can try to buy nat gas forwards to lock in some input, some of your input costs. But there isn't a great way to hedge your outputs today. There are some bespoke products called physically delivered hash rate forwards. And what that means is, say you have 100 petahash of hash rate, I buy it from you at, some value today, $55 a petahash today, and I'll buy it from you for a 20% discount. And then you lock in that value. So you then take, what's 20% of 55, what's that, $11?
20% of 55,
it's going to be $11 off. So I'll buy it from you for 44, and then you're locked in. So now you know what your input, you know where your outputs are going to be over the next 6 months. The problem with that type of contract today is that it requires heavy collateralization, meaning I have to collateralize as both the seller and the buyer. The buyer has to put up whatever the value of that contract is on that day. And then the seller also needs to put up that amount, because there's nothing stopping the seller from just unplugging their machines or pointing them to some other pool or whatever. There's no physical constraint on that.
Right.
You would have to get in, that would be like a default scenario. And then you'd have to, so they generally need to be collateralized pretty heavily. Luxor recently launched a new product called a hash price NDF. NDF stands for non-deliverable forward. What does that mean? It means that I don't actually, as a miner, have to deliver you the hash rate. We look at the reference rate for what the value of that hash rate was, and we settle the difference. You don't have to collateralize nearly as much, because we know the volatility over a certain period is we know what the bounds are on volatility, and we can also introduce margin requirements, maintenance, things like that. And you're not actually exchanging physical hash rate, which if you're having to exchange physical hash rate, that introduces a lot more complexities. The contract gets much longer because you have to have verbiage around uptime and availability and, like what are the default scenarios? And, if I'm below, my delivery schedule, can I top up? Can I go buy hash rate and make my contract whole? All of those things add complexity to a physically delivered contract. And so we really wanted to reduce that complexity by doing this NDF. So let's walk through like the mechanics of what an NDF is like. So you and I, we say in that same scenario, we'll do a 30-day tenor, 30-day contract. Today, hash price, $55. We've seen tenors trading, we've seen that 30-day tenor trade at about 2 to 3% discount to spot. So I'm gonna, if you're gonna buy my hash price, you offer me that discount, I sell it to you, and then over the course of the next 30 days, Luxor or hash rate index produces the reference rate every day, and then we settle daily using a time weighted average over the course of the contract, and then we get to the end. Say it's $60. I owe you the time weighted average difference between 55 and 60. If it was linear, then I owe you $2.50 for that contract. So we can actually, we can take collateral for that, and about right now we say 30%, and when we take that collateral. The reason we're holding on to that is just to make sure that at the end, there's nobody, we can move the funds from the buyer to the seller, whichever side of the trade wins, and also that you're not going to default. And we know that over a 30-day tenor, there hasn't been a period where we've seen that much volatility ever since the inception of Bitcoin. So that's where 30% came from.
Right. Okay. Danny, can you bring up the hash rate chart? So we've spent the last 30 minutes-ish talking about the difficulties that all these mining companies are having.
Yep.
Hash rate is skyrocketed. Why?
So
Because look at
Yeah.
that. That's fucking unbelievable.
well, that's all time. That's a hard one.
but you, I mean, Danny, you can go to the last year. It's the last year everyone's been in pain.
Yep.
And
Basically,
especially, everyone's really been in pain from the drop in about May.
Even in the last 3 months.
it's
Yeah.
been the last 3 months. The last 3 months is really the pain period.
Yeah. Yeah. hash
Anything
rate-
under, I would say, anything under about 12 or 13 cent hash price is really going to be where things start to get iffy.
But the hash rate's up nearly 50%. You know, if you say
Yes.
the bottom's just
Yes.
200, we're nearly at 300. Like, it's up
Yeah.
about 40%. How
Yeah.
is hash rate up 40% when everyone's in pain?
Yeah. Okay. Great question. So, most as I was mentioning about what happened this time last year, there was massive investment happening, but that investment doesn't just show up. If I go buy 100,000 mining machines, they don't show up this month or even next month or the month after that. They probably are going to start showing up within 6 to 9 months. And so those machines were getting plugged in late Q3, mid Q3, late Q3, and now they're all starting to come online. And what I mean by those machines is, when we saw the pubcos going and investing and buying hundreds of thousands of mining machines, Marathon Digital famously bought, 100,000 mining machines this time last year, and they're now all starting to come online. So that hash rate that's coming online now is hash rate that was paid for a year ago and is now starting to show up, which is really going to crunch, the margins on that investment. And so it's going to be interesting to see how this plays out over the next, probably I would say 12 to 18 months.
Is there more to go, do you think?
I believe so. Yeah, I believe there's still more to go, and it's I would say we're getting close to being somewhat saturated in the U.S. market because our energy prices are a bit higher than you can find elsewhere. But I think there's still going to be mining done in other places. So, there is some concern that maybe nation states are starting to turn on machines and mine at whatever it costs just to get around sanctions, that sort of thing.
Concern?
Well, I shouldn't say concerned, but there are some rumors or theories that may be where some of this hash rate is coming from. Say a Russia, they're sanctioned, they can't participate in the majority of the world's banking system currently for what they're doing over there, and they could be taking Bitcoin mining machines, plugging them into their effectively free natural gas generators, and they mine no matter what, or they mine regardless of what the economics look like, and that could be a scenario that is playing out, and we'll see. I think we're going to start to see over the next 6 to 12 months if that is the case. The reason I think it'll take that long is we're getting to the point of like the marginal machine right now is not nearly as profitable. I mean, your margins are single digits, maybe low teens on those machines. And if hash rate continues to grow, that margin's going to continue to come down. And if we reach a point where the marginal machine has a 0% margin and hash rate then continues to grow, we know that there's somebody out there that is mining at a loss, and they may not care because the value that they're getting out of that hash rate is greater than the economic reward at face value.
Then what happens to the public companies? Is it a race between like who can survive the longest?
Yeah. If there's entities out there that are able to mine at effectively zero cost, there is no way for miners to really miners that have to pay for energy to compete.
So that might require Western nations to subsidize miners
if they
keep the hash rate.
If we want to keep hash rate in the U.S., that could potentially be a case.
That's what Jason Lowry talked about, didn't he?
I don't know. I've not heard that.
Mining as national security, I'm sure.
Oh,
I mean, we talked about that on the pod last time.
Yeah.
That mining, mining is a matter of national security. If we're gonna, if the U.S. government wants to protect, its Bitcoin, constituents, that would be something they need to do, is make sure that their Bitcoin holders within their country are protected from foreign influence and foreign intervention.